So you don't think you could buy a house. You don't think you could get into investing. You're afraid, you're not sure what steps to take because you have something wrong, whether it's your credit, you don't make enough money, maybe you have some debt, whatever it is. Let me tell you about 3 different ways that you actually can get into it. And maybe not all of them will apply to you, but perhaps one will. So let's get right into this. We're going to talk about 3 alternative ways from a conventional loan. Okay, we're going to start off with the first one being down payment assistance programs. Now this is for people who don't have any money, but maybe they have pretty decent credit, because you really need to have right around a 680 credit score to get started. And if you don't have a 680 credit score, I can guarantee you within 3 to 4 months, no matter what your situation is, you can make that happen. There are secrets and tricks out there. So just start Googling and researching a little bit about that. Or if you have some money, just pay a credit repair company and they're going to do everything they can to increase it. And it literally takes 3 to 4 months. But the down payment assistance program it's a blessing, honestly. Here's what they do. They have you take a course, and usually they do it like on a Saturday. It takes you like 1 hour, maybe 1.5 hours. Then you get some silly certificate that's worthless. But what you do with that certificate is you submit it to your lender. Now the lender is going to give you, well, not him personally, but a company is going to give you a grant. You owe this money to them. You don't get the money for free. You do have to pay it back. But the thing is, it's a 0% interest loan with 0 payments, and you give it back when you sell your house or refinance your house. So you basically get your down payment. You can get up to 3.5% down. And then on an FHA loan, as a first-time home buyer, you get this down payment assistance program. You get an FHA loan, and you can get into home ownership with very little money. You just need that credit, and of course, you need a job. You need some income verification. Now, the second thing you can do are bank statement loans. This is perfect for the people who own their own business and, tend to kind of write off everything that they are allowed to, and sometimes things that they're not allowed to. So they'll write things off in order to lower their tax liability to the lowest amount that they can, right? Once you've lowered it, you're not paying many taxes, and the government, the IRS, I should say, thinks that you're not making that much money, and the bank thinks the same thing. So they're going to look at your numbers, they're going to look at your last year's tax returns and the year before that, and they're going to say, look, you're making $8,000 a year. We're not lending you anything for that. So there's programs out there for loans that are specific to this type of person. Now what they do is they just collect right around 12 months of bank statements, and they want to see the regular deposits into there. Even if you have regular withdrawals equaling the deposit amount, it doesn't matter. They have very loose rules on these kinds of bank statement programs, and you're able to get into a property with not having the traditional 2-year history of a W-2 job. Now, when it comes to the down payment portion of this type of loan, well, just go back to the down payment assistance program. I just talked about that. You can use DPA programs for the down payment combined with one of these bank statement loan programs. Next thing you know, you're living in a house that you own. You're not making your landlord rich, although I do not mind if you do make landlords rich, as I'm a landlord. But home ownership is one of the best things you could do for yourself and your family, especially if you're young enough and you have, decades to live still. Real estate appreciates faster than money depreciates. So what you're going to have is you're going to have a very positive return. And if you're doing the numbers on the return on investment, you'll kind of see that, look, even if you put your 3.5% down and that ends up being, let's just say $17,000, you'll see that the appreciation on that $17,000, the compounds when your property goes up 10% in value. You make so much money. If you want a number crunch with me, reach out to me. All my contact info is below, and I'd be glad to help you out and kind of show you how I see it and what's the best way to number crunch what the return could be. But it's definitely better than renting. And by the way, right now I am at Nathan Benderson Park. This is an amazing park where the rowing teams practice. There's regattas here. If you look right behind me, you're going to see a few rowers out there, grueling through all the work they have to do. I used to be a rower. It's a wonderful sport. And my name is Maciek Zaremba. I'm in Sarasota, Florida. I'm a real estate agent here. If you have any questions at all, just reach out. All my contact info is below. Okay, now the last way that you can acquire a piece of property is using a DSCR loan. This is called the debt service coverage ratio. Now, one thing is that this is exclusive for investment property, but this is probably one of the best loans you can get right now. It's actually very similar to a commercial loan, how a commercial loan is underwritten for multifamily. And here's how it works. If you could find a property, and this property rents for, let's just say, $3,000, and you acquire it at a purchase price where the principal, interest, the taxes, and insurance all combined, which is basically your monthly mortgage payment, is less than $3,000. It could be $2,999. That is a debt service coverage ratio of over 1.0, and that qualifies. So what do you need to get into these loans? Well, very simple. First of all, you need your down payment. They usually want 20%. If you don't have 20%, you might be able to team up with somebody who has the 20%, but maybe doesn't want to take on the risk themselves. So then you can partner in with them and create a partnership of two people owning it 50-50. You're using your credit and they're using their money, and then next thing you know, you own property and you can start making money on it. Now, one thing you really want to keep in mind is that if you find a property where the DSCR ratio is 1.0 or better, well, it's only going to get better from there. And here's what I mean. You have to look at the long run when it comes to investing in real estate. You buy something, and today it might be 1.0. You have a payment of $3,000 and you rent it out for $3,000. But next year, you're probably going to have a 5% increase on the rent, because that is just the standard lease agreement. So now you're adding another $150 a month on top of the $3,000. Now it starts adding up real good, because the year after that, you're adding another 5%. Now, historically, rents go up about 5% per year. And I know you might have some years where it goes up 10% and others that goes up only 3%, but rarely do rents go down. As a safety precaution, what I recommend is you get out there and actually save up some money, and before you get into one of these properties, have about 2 months worth of rent on the lowest amount. It should be the 2 months worth of rent that you have in a separate bank account, just in case you have a situation happen. Now, if you really want to supercharge this strategy, here's one last thing that you could do. You could turn it into medium-term rentals or short-term rentals. Of course, your municipality may not allow short-term rentals like Airbnbs for 3 days or something like that, but medium-term rentals are usually allowed almost everywhere. Now, what that means is you kind of rent it to traveling nurses, or you team up with construction companies, or when there's natural disasters, sometimes companies need housing for all those people. So they come in and they pay a premium, and you can be the beneficiary of that premium. Medium-term rentals are not really used very often by a lot of people when it comes to landlords, because landlords want consistency. But if you're a hustler and you want to work hard and you want to maximize it, go for it. Study it a little bit, and short-term rentals are even better. With short-term rentals, if your municipality allows it, I'm telling you, you're probably going to at least double the amount of rent that you bring in. So all of a sudden, you have a $3,000 payment, but you're bringing in $6,000. And it's usually seasonal. So you might make a little bit more some months and a little bit less other months, but overall, you're going to kind of double the potential income. So to recap, you don't really need the traditional 20% down, excellent credit score, a job for 2 years on a W-2 working for the government. You can get into home loans with alternative strategies. Now, there are probably another dozen ways that you can get into home ownership. If you have any questions, drop me a line. I'll let you know.